This is basically the income needed to buy a house, and this is coming from, a lot of good government stats. I don't know if you can say good and government in the same sentence, but nonetheless, these are stats that are in here that are validated. And so here's what we got. So you've got the housing market basically showing the kind of dollars of income that it needs to afford the average house. Remember, this is a national average. Going to be higher in Beverly Hills, going to be higher in Fisher Island, going to be higher in down in Miami, going to be higher in Greenwich, Connecticut. But nonetheless, on a national average, this tends to stand true when you take away the super high-end markets for the average market and the average community in an average American city or town. So basically, if you take a look here, right now, look at that spike that has just happened right now in 2022 to 2023. And we're filming this here just at the start of Q4 2023. Look at that. $111,000 that needed to afford a house. Now there's two blend points here. The first is, what are the interest rates that relate to the mortgage, which it's going to relate to the price that you're paying each month for living in the house. The second part is the cost of the house itself, the asset value, the price of the house. And houses are up at least 30% on a national basis going back to 2021, where we had this huge spike as a result of, boom, printing all that money that went into circulation as part of the stimulus checks during the COVID response by the US government. That caused asset prices to go up, that caused housing prices to go up. Then through 2022, what do? We've been raising interest rates, and we've raised them up to the point now that the mortgages right now are about 7.5, 7.75, or even 8, depending on your credit score. So right now you're hovering very close to 8%. Well, when you put a high price of the house and the mortgage rate is way up, the mortgage payment is way up. Oops, so that translates into what it takes to afford a house. Right now, it's $111,000 a year it takes to afford a house. Now, if you back up just 2 years, you are down there at $65,000. If you see, you got 3 yellow bars there, 1, 2, 3. If you're in your car and you're watching, they're listening, on Spotify or whatever, listening to this on the audio version of the podcast, we're looking at a chart here that suddenly jumps up in 2023 to 110, meaning 110,000, and just 2 years, less than 2 years actually, prior, that was only about 65,000 it took to afford a house. And 2 years before that, pre-COVID, we were hovering in the high 40,000, low 50,000 range of what it would take to afford a house in the United States of America. Now we go back to the financial crisis, you follow the chart back, it kind of levels out, and you go back to 2008, 2009, time of the financial crisis when all the fun happened. If you want to know how that went down, you can go do some research or watch The Big Short. Remember, that's Hollywood's movie talking about it, but the core timeline in the movie that they have is correct, and what happened there with the terrible financial crisis led by the real estate bubble in 2008. So you go back and look at that. Now then, what's the best course? People say, I've been seeing this in the headline. Wall Street Journal's had it in the headline. Average newspapers, online have had it in the headline. Yahoo News has had it in the headline. So pretty much everybody, whether you're watching the Wall Street Journal or you're not paying attention, you're just seeing regular daily news, people are noticing this. This is showing up in news feeds as a casual news story on Facebook. So America is hearing this, and there's a lot of people that have been sending in comments that said, Biz Doc, what do? I've been seeing this. This is when will it go the other way and be a good time and be more affordable for me, because my income didn't go from 65 to 110 in 2 years after the COVID response. Glad you asked. Look, now is the time to be patient and to be efficient with your dollars. And basically, there are good markets out there, and there are markets where the price has dropped down a bit. Many areas outside San Diego, California, we're seeing listings that have really dropped back down to 2021 levels and pre-2021 levels. So there may be markets, depending on where your job or your life has you, that you can actually buy a house right now. But you have to be able to afford that 7.75% mortgage, give or take, maybe closer to 7.5, depending on what week it is, maybe a little over 8 if your credit is only around 650, 690, something like that. Nonetheless, there may be markets you can afford it. But don't buy into the, I'm just going to squeeze myself, and I'm going to squeeze myself for 6 months, and then rates are going to come down, I can refi. No, don't assume that. Yes, this week the Fed said we're not raising rates right now, and I'm talking about this week, beginning of 1 month into Q4, Halloween, November 1st, the United States Fed met and said we're not raising interest rates at this time, and might as well just assume that we won't unless there's some really cataclysmic things that happen in the economy going to the end of the year and the beginning of next year. We're probably going to stand pat, meaning leave the interest rates where they are going through Q1 into Q2 of next year, maybe even the June meeting of the Fed, which is 8 months from now when they come down. So, moral of the story, if you're in a market that you can afford and you can get into a house right now, God bless you. You know, if that's what your decision is, but don't pinch your budget and assume, oh, I'm just going to refi in a couple months when the rates come crashing down, because it doesn't look like they're going to crash down. It looks like they're going to be gently going down. So you should assume that rates aren't going to move down meaningfully where you give about a point difference in your loan. So you say, oh, I have a 7.75. Rates are down to 6.5. If I can get a no point, no fee refinance, maybe I could do that. Meaning you don't have to pay money to refinance, because that defeats the purpose of reducing your payment if you just end up paying $2,000, which is like $200 a month. Oh, I saved $200 a month. Yeah, but you paid $2,000, $2,400 to refi, so you just paid it up front. You see what I mean? I know it's a longer term play and the interest rate's gonna be down for the life of the loan and all that, but you have to be sensible about what the refi is and what it does and whether it makes sense for you to do it right now. So the other thing is, don't buy into the hype. For the longest amount of time, oh, you gotta buy a house, gotta buy a house, gotta buy a house, because it's an asset and the price is gonna go up. First of all, when you look at the prices on a national basis where we are right now, you can't assume that the prices are gonna keep going up from there, because if people can't afford it today and their income hasn't come up, so you're telling me that interest rates come down, but the price of the home keeps going up, meaning you buy a home and it keeps going up in value and it's like a piggy bank or a savings account for you, you got the same problem on the other side. So remember, if you are not in a house right now, and by that I mean a piece of property, a townhouse, a condo, or a small home, having purchased something, if you're not in it right now, remember, you're not handcuffed to an asset that has recently gone up as much as 33% more in certain parts of the country, and that includes higher insurance, that includes higher property taxes. So if you are able to afford a house that's at a higher price recently, remember, with that higher price when you buy it comes higher property tax and higher cost of insurance, because insurance relates to the cost of replacing it in the event of a fire, and the value of the house translates to the premium of the insurance. Just like having a more expensive car, your car insurance is higher than having a less expensive car. You know, you have to respond to all those underlying costs on it. You have to insure it. You have the maintenance on it. So if you're not in a house right now, do not feel bad and do not buy into the hype. Do not be guilted into somehow you're left behind, because as a renter, you have more options now. You have the options, if you're not married or you're not in a long-term relationship, don't have any kids, something like that, you have the option to have a roommate. Now, having a sane roommate is not an invasion of privacy. It's an economic benefit. It can be an economic benefit so that you're renting for a while, saving your money, being conservative, letting the economy flow through, but don't buy into the hype that you are somehow less or left behind. I've been hearing that, and I've been people talking to me, well, I feel so bad because I'm just a renter. You're not just a renter. You're a person who is taking economic control of your life, and you're saving your dollars, and you're waiting to these waves to come back. Will housing prices come down? We hope they come down somewhat. Will mortgage rates come down meaningfully mid-year next year? We hope somewhat. We also have the presidential election in the United States coming up in the November, fourth quarter of next year. And around presidential elections, there's all kinds of gamesmanship, manipulation with economic data. And maybe that helps, you know, interest rates on mortgages come down. Maybe there's government pressure behind the scenes because they're going to want the economy to look better so that you'll vote for them or vote for them. But don't buy into the hype. Don't buy into the hype. Rent, be efficient with your dollars, and just get smart about what is happening with the world around you in terms of the economics of owning a house. Get smart about it. Make this next year a year where you are basically going to college on what it is to own a house in an increasing cost environment, especially if it's going to be a first-time home buying opportunity for you. And I'll tell you, not everybody is doing well in this economy. And I'd like to transition to the next topic. Take a look at this. This is the credit card delinquencies. Take a look at that. If you're listening in your car or you're on the audio version on Spotify, let me describe it. What we have here is a chart that starts in 1991, and it shows a red line going up and down with the amount of credit card delinquencies. And we suddenly, at the end of 21, the beginning of 22, delinquencies have shot up. The delinquency rate is 50% higher today than it was 12 months ago. Let me say that again. If you're a bank and you have given credit cards out to people, and last year there was 100 people delinquent per month, let's just say. Right now, it's 150 people delinquent per month, which means that inflation and the economy is having a pinch effect on people, and all the more reason that you should be on top of your economic game to ensure that you are in a safe and, as we say, warm, dry, well-fed, and safe place with your finances. And stretching into a house that's somewhat higher priced, and the high interest rates right now, I wouldn't do that. And you can see people around you with the credit card delinquency rates going up. What's up with that? It's because it's not just housing that's up. Inflation has brought everything in the economy up. So I hope that's helpful today. I hope these charts were helpful. And again, if you're listening or just driving with us, hope I've been able to describe them so you can understand what's going on as well.